This is FRM Part 2, Book 5, Risk Management and Investment Management, and the chapter on performing due diligence on specific managers and funds. When I read those two words, due diligence, I think of two other words, hard work. And I think of my sons on a Saturday morning when I wake them up early and say, all right, let's go out and do some yard work. And they complain and whine because they know it's going to be hard work. They're going to need to get out their shovels and maybe their axe and maybe their gloves and some water bottles, and they know it's going to be a long day. And the authors of this article do a really, really good job of emphasizing the hard work aspect of due diligence. In fact, this is taken from a textbook that they wrote called Hedge Fund Investing, a Practical Approach. And part of their introduction is a description of the results and the outcomes of performing good due diligence. And I'm going to quote a sentence from the chapter that reads like this: "The purpose of due diligence is to lower the risk of surprise." And quite frankly, I'm a little jealous that I didn't think to couch it in those terms, lowering the risk of surprise. I wish I would have had that term when we did our entire chapter on risk culture many, many recordings ago. But the authors go ahead and focus on four areas of due diligence: the investment process, risk management, the operational environment, and a business model assessment. And you'll see that as we go through these learning objectives. We'll talk about reasons for failures of funds, elements of due diligence. That's probably a super important one. We'll look at some questions that investors can consider, criteria, the fund's operational environment, and the business model. And then we'll end with a handful of slides on a due diligence questionnaire. Let's go ahead and begin with some reasons for failures of funds in the past. And you could probably cover your eyes, and based on our recent recordings on hedge funds, you would be able to come up with most, if not all, of these. So poor investment decisions, that makes perfect sense. Fraud, excessive leverage. I like this one above all. When I teach my students about leverage, I always talk about the beauty of leverage and the ugliness of leverage. And so failures is the result of leverage that does not pay off. Unexpected or extreme events. Let me swing back to that. What did the author say? To lower the risk of surprise. So when one of these unexpected or extreme events, I know that sounds like a paradox, but when one of these events occurs, good financial risk managers should be prepared for that. They should not be surprised. And then going back to discussions we had in the past on governance issues, poor controls, of course, contribute to these failures. All right, how about a couple of areas when assessing investment managers? One of the assignments that I give my undergraduate students is to use our Morningstar database and to record a video outlining the characteristics of a specific mutual fund. And I always emphasize to them, tell me about the managers. So they go in and they look at the managers, what is their background? How long have they been doing this? What is their performance records? And can we make an evaluation on their integrity levels? My students are always telling me about their fund managers who have professional designations like CFA or FRM and others that are out there. And so my students, as 20-year-olds, they're super impressed by professionals who have continued their education. How about the investment process? Of course, what looks like the strategy inside of the prospectus? For a mutual fund manager, this perspective is pretty constricting. The fund manager says, look, I'm going to invest your money in these equities or these fixed income securities or these kinds of securities. But with a hedge fund manager, there's much more leeway, but still there are strategies that are outlined in the prospectus. And then the other side of that is, okay, here's a strategy, but can the fund manager explain the purpose of that strategy and what those key decisions are going to be and who's going to make those key decisions? How about some control issues? Let's start with risk control. What kind of alpha are we going to use? Remember in a previous recording, there are a bunch of different alphas out there. We can use Jensen's alpha. We can use the information ratio. We can use Sharpe. We can use all sorts of things out there that will contribute to the computation of some kind of alpha, not least of which is the selection of a benchmark, of course. And let's go back to our discussion on governance issues. So the internal controls. Are there controls meant to detect and prevent fraud? What are the limits of the amount the fund manager can invest in a particular strategy or a particular investment? Of course, this has everything to do with the structure and the outline and the integrity of these internal controls. About questions that investors can consider, right? So let's talk about strategy. What kind of strategy are we going to pursue? Is it going to be a strategy that's consistent throughout the year, or are we able to change that strategy? And then the big question is what kind of derivatives are going to be used, and to what extent are those derivatives going to be used? Remember our discussions on long-term capital. I think it had a notional principle in their interest rate swaps and currency swaps that approached $1 trillion. Whatever 1 trillion is, that sounds like a big number. How about track record? Not only are we looking at the trends of performance of a fund manager over time, so we can easily get 10%, -4%, 18%, and then we can look at the alpha inside of that track record. But then we need to do a comparative analysis. We need to compare against maybe a benchmark or the peers. We also need to consider size of the investment's assets. Remember, we talked about how the performance of hedge funds tend to increase with the size of the fund. And then that track record, has it been audited by a third party? Remember, the federal government, at least here in the United States, under the guide of the SEC, has certain kinds of rules that for manager performance announcements and kind of a calculation of that performance. And then finally, it's one thing to say, I did 18%, I did 14%, I did 22%, but what happens when things are crashing around me? How did the manager perform during times of economic stress? How about a background check? Of course, what is the opinion of former employees? Whenever I serve on a search committee, one of the first things that I always do is say something like, hey, let's pick up the phone and call those people over there who worked with this individual for 1 year or 5 years or 10 years. And you get a good sense of those quality of the references and the background there. How about ownership? Is there an ownership investment in the fund, or is there not? Look at that last circle point. A stake in the fund can help align managers' interests with those of investors. That makes perfect sense. All right, how about a risk management process and an assessment of that process? All right, does the fund or the family of funds have a written procedure, right? It says something like, look, we expect to take this much risk, and here are the procedures for us to assume that kind of risk. And if that risk changes, then we have a written policy to handle that. Of course, we need to consider systematic and unsystematic risk factors, and then information technology. Of course, how are we going to quantify that risk? Notice that a proper risk management process should assess. If I were writing this chapter, I would go with the old identify the risks, quantify the risks, and manage the risk. But from this governance perspective here, we need to have written policies and procedures, of course. Do we have a chief risk officer? Do we have a risk committee? And what are their roles and responsibilities? Yeah, this is important here, right? What are we doing in terms of a strategy? I mean, ultimately, we're going to invest in some type of a security, whether it's something as simple as a share of stock, or in the alternative investment universe, like a gold mine or a farm, or you guys remember my examples of Barbie dolls and Indiana Jones movie memorabilia in previous slide decks. So we need to make certain that there is a policy and a strategy under which the fund manager is valuing each one of these particular securities. So look at those diamond points. What's the proportion of the fund's assets that are valued objectively through reliable market pricing, like a share of stock or a credit default swap, or those valued subjectively through modeling, like the Indiana Jones movie memorabilia? The Indiana Jones hat might sell once every 5 years or something like that. Is the valuation process independent? In other words, are there any biases in there? Are we going to say something like, boy, I really love those Indiana Jones movies. I'm willing to pay whatever the market price is out there because I love Indiana Jones and I think the price is going to rise. There's some inherent bias in there, and that's clearly not an independent evaluation. Can prices be overridden for valuation purposes? If so, by whom? So this swings back to the previous slide. I'll go back to this. Written policies and procedures. Clearly we don't want to have something in there as precise as, when evaluating anything from a famous movie, we need to follow these processes. But clearly there needs to be some general sense of the valuation process. How about the two L's, leverage and liquidity? Of course, there is the beauty of leverage, which seeks to magnify returns, whether it's in regular old equity markets or derivative markets or alternative investment markets. And then there's this paradox of liquidity. If we go to the floor of the New York Stock Exchange, there's tons and tons of liquidity. But if we go into the alternative markets, there's probably less liquidity available. So what we're doing then is we're trying to find these assets that don't have as much liquidity that might be undervalued. And so a manager is going to search for leverage and search for lower levels of liquidity to try to magnify returns. But the consequences, of course, are excess leverage and illiquidity can result in substantial losses. And so there's that trade-off, does the leverage pay off? Does the illiquidity pay off? If it does, then that's great. That's called the beauty of this stuff. But there is ugliness if there are substantial losses. And so part of this risk management process assessment is to take a look at the leverage ratios and the levels of liquidity of the securities inside of the fund, and then make a judgment whether or not it's worth it. And of course, this can be as simple as marginal costs, marginal benefits, but a lot of times it's a little bit difficult to quantify at the margin liquidity and leverage inside of a fund. Tail risk, do I even need to mention this? Haven't we spent hundreds of videos talking about value at risk and exposure? And of course, these are the result of the simple fact that asset returns probably don't follow a normal distribution. There's going to be some skewness. There's going to be kurtosis. So look at that second diamond point that we put in there. The fund's preparedness for tail risk, right? Low probability events that are going to have a substantial or a high impact. Remember when we talked about the roles of the chief risk officer and the risk committee? Of course, one of those was to establish and write and maintain and edit these risk reports. And these risk reports should be, they should be concise. I mean, nobody wants to read thousands of pages. They should be short. They should be brief. But what is important is that since they are concise, then they should be written and edited and distributed on a regular basis. Now, regular basis probably doesn't mean every day, but it probably means that, hey, let's talk about what's going in this report on a weekly basis, and then let's put this together in some kind of a formal report. Probably monthly sounds like a good idea. How about the fee structure? How about additional fees after the watermark? How about blackout periods or lock-up periods, redemption limitations? Of course, this is all part of an evaluation of the cash flows that go into and out of the fund, and we do this from the terms of the fund. And we can assess those and compare them across the spectrum. How about a detailed assessment of internal controls? All right, so we've got this chief risk officer, we've got the chief executive officer, and then we have this board. Is the CEO willing to go all out to enforce them? And what's the answer to that question? I mean, we've talked about this many, many times before. The answer to that question is, of course, yes, but not all funds are probably going to follow that. So part of the due diligence is to determine whether the CEO is willing to go all out to enforce them. But if there is a chief risk officer, well, then, probably the answer to that question is yes. Are the fund's personnel qualified? That's probably difficult to determine, but one way that it's possible to make that determination is to search through the prospectus and go through the qualifications of all of those individuals. And as part of that process, a good financial risk manager will probably uncover those governance issues that we've been talking about before. Disclosure, of course, disclose. What did we say just a few moments ago? We want to write these reports. We want them to be concise. We want them to be accurate. But they probably have to pass through some kind of an independent legal counsel. And there's going to be intense scrutinization of conflicts of interest. Remember that there are direct and explicit conflicts of interest, but we also want to avoid the appearance of a conflict of interest as well. How about an evaluation of service providers? Investors must assess all the services provided by the fund. We have all these people out here. We do all this work inside of the fund, and then we rely on third parties or consultants or whoever that is outside. Let's make sure that we figure out who those individuals are or those groups of individuals, and if they in fact follow similar control procedures that are inside of the fund. Business model risk. I think you guys will remember that I've said many times that my undergraduate degree is accounting. So a lot of times I tend to think like an accountant, at least initially, before my financial manager training takes over. But when I think of business model risk, I always think of the income statement, right? Revenues minus expenses. And so, what's the goal of any business organization is to generate lots of revenues and to incur minimal kinds of expenses. Now, that's from an accounting standpoint, but then my financial manager training then kicks in and thinks like, okay, it's not just revenues and expenses, it's cash flows. And so I think about business model risk as the variability in those cash flows. So notice in the context of funds and hedge funds, how that manager will make decisions that will result in a liquidity crunch. Okay, so that's a little bit, low revenues minus expenses over a short time period, right? Liquidity, outright failure, the fund has to shut down, or insufficient funds to execute the fund's chosen strategy. So that lends itself right into some kind of an evaluation of cash flow management, which includes all sorts of things, not least of which is working capital. What's the example there that we put in the slide deck? Allowing too many concurrent redemptions may leave the fund short. That makes perfect sense. All right, so what should the investor do? Assess the revenue stream. All right, I said that already. So stability and consistently, boy, do we want to have revenues that go way up and way down? Of course not. And then let's assess that gap, revenues minus expenses, right? So all those operating expenses. Ascertain that key persons in the fund are insured. This is all part of the governance issue and quality control. We need to have contracts in place, whether they are employment contracts, whether they are insurance contracts. And then finally, boy, I did use that word, sufficient working capital. All right, indications of fraud. Frequent instances of illiquidity, high amounts of illiquid investments. How about frequent litigation? How about abnormally high performance? How about frequent shorting transactions? How about qualified opinions or a disclaimer of opinions? All right, so here we need to think like a really good combination of an accountant and a financial manager to be able to sift through the financial statements and sift through performance measures and quality of performance over some time period to make an assessment of fraud. Here's a really good example. Bernie Madoff, oh boy, 4,800 clients. He used some kind of a strategy under which he told people that he invested in securities and then used some derivatives to manage this. He bought some derivatives, maybe some options, and then he wrote some derivatives, maybe some other kind of an option, when in effect he was just using one big old fund and receiving new contributions into that fund. And then those few investors who wanted out, he just used that. And so it looked like he was providing lots and lots of return for those investors who wanted out. And then that was used to convince the other investors to stay in because those funds will compound over time. Who wouldn't want to have a 40% compounded rate of return over 5 or 10 or 20 years? Look at the red flags. The firm was founded a really, really long time ago. Even before I was born, he was chairman the entire time. He employed lots of his friends and relatives. There was super low correlations, and Wall Street never really saw lots and lots of his performance, but clearly they never saw anything about his trading volume. So look at those charges: securities fraud, mail fraud, wire fraud, money laundering, false statements, perjury, etc., etc. You know, what I found most disturbing about this case was that he used his relationship, his personal relationship and his religious relationship with his friends and acquaintances to raise all of this capital. All right, how about that last learning objective? Elements of due diligence questionnaire. So what kinds of questions can we ask? We can ask questions on general information on the manager. We can ask questions on general information on the fund. We can ask questions on execution and trading. Of course, we want to know about strategy, we want to know about third-party research, and we want to know about compliance process. We want to know about business plans, disaster recovery, we want to know about risk controls, and we want to know about the fund's terms. So I would go ahead and memorize these 9, but if you go back here quickly, and you just look at some of the circle points here: reference checks, ownership forms, past performance, fee structure, guidelines, speed and accuracy of trading. You know, if you go through those circle points here, it sounds an awful lot like we've covered those inside of this slide deck. And so I would know those 9. They're probably just a summary of what we've discussed inside of this deck. So look at that last one. Describe elements that can be included as part of the due diligence questionnaire. This is a questionnaire summarizing all of those learning objectives. So if you know that final one, then you can work your way back to be able to answer questions on those earlier learning objectives.